Good evening, ladies and gentlemen. This is Clueless 8. It's the end of the day report for a volatile Tuesday, January 12th, 2016. I don't need to remind anyone that the last couple of days since last week, since the beginning of the year, January 4th, the first business day of the year, trading day of the year, has been probably one of the most volatile times of the market that's been seen ever. Supposedly, this first part of January has been the most devastating to the markets in history. So, taking it for what it's worth, let me give you a couple of quick observations. There is a global imbalance on the currency front due to the Chinese yuan renminbi devaluation that's causing havoc in emerging market currencies, and the ripple effect of it has been the volatility in the US markets. The volatility primarily has been on the downside, as we can clearly see here. Behind you, you see the backstage of the market, i.e. the E-mini S&P 500 index futures, which I use as a proxy on a 24/7 basis to figure out what to do. Despite the speed, despite all types of strategies and speed and mechanics of what a trader can do, it is very, very difficult, both on the long and short side, at these levels in the market that we're seeing, and I'm going to get into them in a few minutes, to go convincingly short. And of course, going long is a terrifying proposition, primarily on an emotional basis. The internals, the technicals are all suggesting a pretty powerful retracement reflex bounce on the markets that I've been talking about for a couple of days now. And positive divergences are emerging on the basic internals, on the stochastics, the McClellan oscillators, also on the secondary indicators like the New York Stock Exchange and NASDAQ McClellan oscillators, sentiment indicators in the form of negative sentiment, as in bulls versus bears, bears being almost at 70%, at least on the so-called semi-pro investment newsletter sector, and bulls being at 15%, which I posted earlier on. And let me tell you that that's one of the lowest readings in the past decade on bulls that I've seen. When you get a 15% number, you get a tactical retracement bounce, which comes from nowhere in the face of all odds and negative barrage of news that keeps on hitting the market, in the face of massive fear in traders and investors. And that's what looks like, again, I stress, underline the word, that's what looks like is a strong possibility as I speak. So let's get straight into the technicals. We know what, before I get into that, we know what the global risks are. There's China. There is the fear of the oil collapse and the fear of a $300 billion bond restructuring that was mentioned today, which is in the high yield junk bond market, primarily due to the collapse of some of the largest or imminent collapse of some of the largest commodity companies like Freeport McMoran, for example, FCX, and the ripple effect that has in the equity markets. If you think about it, Amazon has nothing to do with what's happening in China or oil. US consumer is still reasonably strong, and a company like Amazon is still taking a dominant market share in the online business, not to mention their AWS or Amazon Web Services, which hosts a significant number of the world's largest companies on their servers, such as Facebook. Most people don't know about that. Facebook servers, Facebook hosts their domain, or a good portion of them, on Amazon Web Services. Anyway, let's get straight into the technicals. Let's cut out all the noise. Let's see we know nothing about what's happening on the global macroeconomic front and just look at the structure of the charts, and let's go from there. Keep in mind that I am just like all of you, a simple student of the markets. I'm a passionate learner. I've learned quite a bit over the past 2 years, if not more, and over the past 6 months, and if not over the past week. And I try to guide people as prudently as possible, and there have been some large tactical winners for traders, mind you, both on the market in the form of the SPX and the spiders, SPYs, the UVXY, the proxy for the VIX, for a couple of small cap powerful movers like Apollo, FXCM, and a bunch of others. I'd like to remind people or point out that the BXLT, the Baxalta, on the common, it was good for a couple of points, but on the forward-looking weekly calls on Baxalta and the Shire buyout of Baxalta was a total disaster. Just the way the markets were. I wasn't happy about it. Saying all that, let's get straight into technicals. This is a chart of the S&P 500 E-mini futures from the highs of 2134 down to the bottom of the heap barrel on August 24th. The slightly higher retest on September 29th. This particular hammer reversal that has to be respected on the 11th, which was yesterday, and this is where we are right now. We have bounced from 1890, which I had projected once the market started to fall out, to 1934. Do the math. 1890, let's say 1892, 8 and 34, 42 E-minis, or almost 50 S&P points from the lows. Tactical traders are making money. So let's see what might happen. This is the uptrend support line from the lows of August 24th, the flash crash, September 29th, and now. So here we have somewhere around, let's call it 1950. Above 1950, you enter into and you regain entry into the uptrend zone. Where can we go from there? All I did was I looked at the supply points, which is pretty much this level here, and the support level, which held for a while in the form of a dragon bullish pattern. So I would call the 1980 and 1990 zone as a point where the market can have a intermediate term V-shaped recovery. If we fail the 1980, Technically speaking, we'll come back and retest 1950 on the E-minis. That's roughly about 1955 or 56 on the S&P. Try to bounce. If we fail that, I can assure you we're going to test this 1900 level again. Break the 1900 level. The next level of support comes in around 1860. And of course, we have the flash crash lows, of around 1825 to 1830 on the E-minis. I'll show you the S&P on the next video cast, so you can measure that against the S&P that most of you guys are used to. So at this point, futures are up about 7 overnight. Couple of things to keep in mind. The distance traveled, which I keep on talking about. I like to keep things simple because I'm a simple guy when it comes to this stuff, okay? The distance traveled from the moving averages, the downward sloping moving averages that you see here, the 50 and the 34. And I've said this a zillion times, but repetition is the key to success. Ask Donald Trump. Just kidding. So bottom line is, this standard deviation down here is not this dramatic fall, which was almost a -9 standard deviation. This could be called a -7 to a -8. This was a minor one. This was probably a -3. When you deviate from the highways that are the 34 and the 50-day moving averages by that degree, you will have a retracement bounce. No questions asked. Now keep in mind that, and I'm going to zoom in a little bit closer, that at this point we have we touched the 50, the downward sloping. Sorry, that's not the 50. That's just my trend line. Sorry. We hit the downward sloping 5-day moving average 5-day SMA, which is the trader's line, if you want to look at it that way. We need to see this turn up. We need to see this turn up. In order for the yellow line to turn up, which is the 5-day moving average, you need to see a powerful move up, another 200 to 300 point day up, which pressures the 5-day moving average to move higher. Therein lies my thesis that we could get to 1970 to 1980, which I've been talking about as a retracement bounce on the algo HFT charts repeatedly, which is a significant amount of profits for traders who are buying at this level. Look, we don't have a crystal ball. I have no idea what exactly the Chinese masters are doing out there. All I know is that I have a pretty good understanding of global economics. I do understand that there's some serious stuff going on there, which are having ripple effects in the US, but I also do know that central banks are not stupid. They know what's going on, and they'll take whatever it takes to fix it. It doesn't mean we're going to go back to new highs. It simply means that we can pay these retracement bounces to the fullest and be reasonably happy traders. So let's look at this again before the next 1.5 minutes is over. So at this point, you look at this here. You look at this tail. That's 1967. That was a reversal point on the 8th. Once we hit that, expect some selling. But I believe that this pattern, and I'm going to stick by it for now, given that it's monthly options expiration on Friday, I believe that this pattern here gets resolved, which is around 1980 to 1990, right there. So if you could capture 80 points on the S&P 500, you don't need to look for that next stock. Therein lies the suggestion that try to play the indices instead of trying to pick some individual stock, which is driven by individual news events and held hostage to risk by whatever the news is on that particular company. That's it. You got, I literally have 10 seconds. You got and I've shown this so many times. You got a nice stochastic turnout. You got the McClellan oscillator turning. And that's